Welcome back to the Explainer. So today we are going to dive into exchange-traded funds, or ETFs. But look, we aren't going to look at them the way your average retail investor does, as those passive, kind of sleepy retirement tools. No way. Today, we're treating ETFs as the highly scalable modular Lego blocks of modern quantitative portfolio construction. We're drawing our insights directly from Chapter 4 of the incredible book, 151 Trading Strategies. And we're going to tear into the math, the mechanics, and honestly, the sheer elegance of systematic ETF trading. Okay, here's our mental roadmap for this explainer. First up, ETFs as Lego blocks. Second, the momentum engine. Third, alpha and selectivity. Fourth, exploiting inefficiencies and decay. And finally, a multi-asset trend-following capstone. We're going to climb this complexity ladder rung by rung.
Section 1. ETFs as Lego blocks, the abstraction stack.
Okay, let's dive into this. Before we get into the heavy math, we absolutely need a fundamental paradigm shift. Imagine you want to trade a sector rotation strategy the old-fashioned way. Synthesizing that portfolio from underlying stocks means you are dealing with a massive, literal operational nightmare. I mean, you're processing data for 500 individual stocks, managing super messy corporate actions, splits, dividends, and navigating all those micro-liquidity issues, but when you use ETFs, you wipe all of that away. And this brilliantly illustrates the elegance of the ETF. You're trading at a much higher, vastly cleaner operational level. You treat the entire sector as just a single modular component, an abstraction Lego block. Section 2. The momentum engine. Strategies 1 and 2, sector and dual momentum. Let's move to and see how this builds our very first strategy, sector momentum rotation. So the mathematical formula for cumulative return is right here. Now, I know it might look a little dense, but the intuition is actually incredibly simple. We just take the price of the ETF today, divide it by the price from T months ago, which is usually a 6 to 12-month formation period, and then just subtract 1 to get our percentage return. That's literally it. It's a pure, unadulterated measurement of exactly how fast that specific sector is moving. So the crucial point is how we actually execute this out in the wild. First, we take all our sector ETFs and we rank them by that cumulative return metric we just figured out. Then we apply a strict decile sort logic. We go long on the top 10%, the absolute undeniable winners. Then we short the bottom 10%, the absolute losers. Doing this creates a dollar-neutral portfolio, which is awesome because it means we're largely insulated from broader, chaotic market swings. Finally, we just hold that position for 1 to 3 months before we recalculate and rebalance the whole shebang. But wait, what if the whole market is crashing? Everything is just totally tanking? That's exactly where strategy 2 comes in, adding a moving average filter to create what we call dual momentum. What we just did in the first strategy was relative momentum, just ranking ETFs cross-sectionally against each other. But dual momentum adds absolute momentum into the mix. We essentially require the broad market ETF's price to be strictly greater than its moving average over, let's say, 100 to 200 days. If the broad market is trending down and totally fails that test, we don't buy the winning sectors. Instead, we park our funds in uncorrelated safe haven assets like gold or US Treasuries. It acts as an automated built-in defense mechanism. Section 3. Alpha and selectivity. Strategies 3 and 4. Multi-factor upgrades. Okay, time to level up our toolbox. For strategy 3, alpha rotation, we are swapping out that basic cumulative return for Jensen's alpha. We derive this from the famous Fama-French 3-factor regression. Now, what this beautiful piece of math actually does is strip out the returns you'd get simply from generic broad market exposure, the size factor and the value factor. Actually, think of it more like aggressively peeling away all the standard market noise. Once you subtract all those standard factors out, whatever is left over, that epsilon error term right there, that is the ETF's true independent outperformance. So we start ranking our ETFs by this highly refined alpha, instead of just raw, dumb price movement. Now let's push it even further with strategy 4, R-squared selectivity. Here we add a fourth factor, Carhart's momentum factor, to our regression so we can compute the R-squared. While the math behind R-squared is foundational statistics, the real-world translation you need to lock into your brain is this. R-squared measures how much of the ETF's return is just mindlessly tracking the broad market. Therefore, 1 minus R-squared defines our active selectivity. It's the exact specific portion of the return uniquely generated by the ETF, completely unexplained by broader market forces. Now, what's really interesting about this slide is how we use these metrics to find the absolute perfect trade. We use a double sort matrix. First, we bucket our ETFs into deciles by their R-squared, right from low to high. Then, within those specific buckets, we sort them again by their true alpha. The absolute sweet spot is the exact intersection of low R-squared and high alpha. Why? Because it means we're zeroing in on ETFs that are highly selective, charting their own unique course, and generating massive independent outperformance. We buy that sweet spot and we sell the opposite corner. Section 4. Exploiting inefficiencies and decay. Strategies 5 and 6. Reverting and decaying.
Let's completely shift our tone for a second. Trend following is all about riding the wave, sure, but strategies 5 and 6, they are entirely about exploiting structural and mathematical flaws within the ETFs themselves. Strategy 5 is a super rapid mean reversion trade that uses a metric called internal bar strength, or IBS. It basically looks at the previous day's close price relative to its high and low. This elegantly simple math always spits out a number between 0 and 1. If an ETF's IBS is creeping close to 1, it closed right near its absolute high of the day, meaning it's rich and probably overextended. If it's close to 0, it's cheap. So we build a fast, dollar-neutral strategy, we short the top IBS decile, the overextended ones, and go long on the bottom decile, betting they're going to quickly snap right back to the mean.
Strategy 6 dives into the very dangerous shark-infested waters of leveraged ETFs, or LETFs. Because these funds have to violently rebalance every single day just to maintain their 2x or 3x leverage, they suffer from a nasty mathematical flaw called volatility decay or rebalancing decay. Over the long term, this daily math tax seriously drags the returns down. So quants exploit this with a dual short strategy. You literally short the leveraged ETF. And at the exact same time, you short the inverse leveraged ETF on the same underlying index. You're shorting both sides just to harvest that structural decay. But guys, a massive blinking red warning here. While the long-term math is absolutely on your side, there is immense, terrifying short-term tail risk. If the underlying index spikes aggressively in one direction, one of your short legs will blow up entirely before the decay has time to save you. Section 5. Multi-asset trend following. Strategy 7. The capstone. All right, we've finally reached the top of the abstraction stack. For strategy 7, we take our massive, universe-wide bucket of ETF Lego blocks, equities, bonds, gold, commodities, all of it, and we rigorously filter them. They must have a positive cumulative return, and they absolutely must be trading above their long-term moving average. Only the strongest survive this cut. To weight them, we use the specific capstone weighting formula. Now, why use this exact formula? Because mathematically, this seamlessly equates to Sharpe-ratio maximization using a diagonal covariance matrix. It perfectly, dynamically balances the raw momentum of the asset against its inherent risk, all completely automatically. It's brilliant. Which leaves us with a truly fascinating question to close out on today. We've seen exactly how powerful, scalable, and mathematically precise these ETF Lego blocks really are. But as more and more quants catch on, snapping these exact same blocks together, running the exact same multi-factor regressions, exploiting the exact same volatility decay and momentum rules, will the market's structural alpha eventually just be built completely out of existence? Will the massive proliferation of systematic ETF trading eventually arbitrage away these very inefficiencies we've just uncovered? It's definitely a provocative thought to chew on. Thank you so much for joining me on this explainer, and I'll absolutely catch you next time as we continue to decode the fascinating mechanics of the market.